Board Mihir Shah, Vice President and Research Analyst for India Consumer at Nomura, joining us this morning. Mihir, currently the biggest concern from a consumption standpoint seems to be the monsoon. How much of it is likely priced in, and what could the adverse impact of that on demand be? Rural, urban, your take.
Thank you for having me. Yes, you're absolutely right. I mean, after seeing 2 consecutive years of above normal monsoon, we are likely to see below normal monsoon this year. Secondly, it is going to be an El Nino year, so you will see some impact of that as well. But how concerned are we? Not while there will be some issues, but we are not very concerned, largely because El Nino, which is kind of indicating that you will have weaker than expected monsoons, is going to be in a weak to moderate range over June, July, and August, and will only strengthen in September at the fag end of the monsoon. Plus, when you look at the Indian Ocean dipole, while right now it is in neutral zone, if Indian Ocean dipole turns to positive over the coming month or so, then it can negate the impact of El Nino. So there is a possibility that while there will be an El Nino, there are certain negating factors which we will watch out for, which can support the below normal monsoon that is expected. So that's one. Second is that, like I said, this is going to be a below normal monsoon after 2 consecutive years of above normal monsoon. If you look at the reservoir levels, they are at 15% above the 10-year averages. And if you look at the government's buffer stocks, they are also, 2x of what their normal stock levels should be. Plus, there are district level mitigating factors that the government is putting in place, which should be supportive for rural. So while we will have a weaker than expected Kharif output, there are certain mitigating factors, and we are not as perturbed as it should be.
Interesting you say that, and you are citing in your note as well, Mihir, the fact that there are strong buffers, both when it comes to reservoirs as well as rice stocks when it comes to rural. Having said that, Mihir, what is it that you're noticing in terms of where rural demand stands while it still continues to outpace urban? Is it at the same pace as it used to be earlier?
No, thank you. You're right. I mean, rural demand since the 4th quarter has seen some moderation, while urban demand, on the other hand, has seen some initial pickup. The gap has been narrowing. While rural continues to outpace urban, we are seeing a narrowing of gap. We believe that can likely continue. At the same time, if you look at many of the staple categories, many companies have put in low to mid single digit pricing. So along with a likely weaker Kharif output, little bit of inching inflation, there is going to be some pressure on rural demand. But like I said, there will be, so the improving trajectory will stop, but it can be around a range-bound level is what we are thinking.
Mir, hi, while monsoon play a very important role, over the last 4 to 5 years, there has been a lot of concerted effort to improve water availability and storage for agri purposes, and the new schemes of the government which have been introduced, whether it's on the state level or central level, have led to more less dependence on monsoon. How much of that has been factored in by you?
No, you're absolutely right. If you see in our monsoon monitor report that we come out every fortnight over these monsoon period of 4 months, we have indicated that the irrigations have over the period of years improved, and the dependency of Kharif has continuously been going down over the years. And there is a increasing saliency of Rabi crop output. So now, we are not largely dependent on monsoon as we were a decade ago. And Rabi crop also has an important point that we are playing out. Again, like I said, reservoir levels are healthy at this point of time, and you can expect some support on Rabi output, even if there is some impact on Kharif output.
So let's talk about some of the, company-specific moves that we've seen. And I have to start off with the ITC, considering it really has been the outlier when it comes to pricing. How do you see that story unfold?
No, ITC, at the beginning of the new year, we did see a very sharp increase of 40+% increase in tax. And that was coming after many years of no increase in tax. So while it was a very sharp move, it was also a surprising move and was not expected. 40+% increase in tax, company has passed on anywhere between 25 to 30% pricing. So you will see this not only impacting volumes. So we have penciled in a high single-digit volume decline for the quarter. But more importantly, even your margins, because your tax increase is higher than the price increases that they've been able to take. So you will see closer to 20% EBIT decline on cigarettes. Now that is a very sharp decline, and you can already see that in the stock price. Post 1Q, we believe the worst can largely be over. So the volume and the EBIT decline of high single digits and 20% on EBIT will start reducing from 1Q. However, on a 2-year CAGR basis, we still have a flat earnings growth for ITC, and hence we have a reduced rating on the stock.
Understood. So while this has been quite a sharp re-rating, you're still waiting for more signs as to how the pickup will be. What about consumer durables? Do you track that, Mihir? And is that a space which you're looking out for, just given the fact or the way in which the weather is shaping up?
So I have discretionary and staples under coverage. Durables is covered by a colleague of mine.
Okay. I'll switch focus to paints, Mihir, because that's the other space which you're constructive on. In terms of the Q4 numbers, the Asian Paints numbers were extremely strong. The question is whether that's one-off or whether that can sustain through FY27. It's one of your top picks. What's keeping you positive?
Yes, no, we had an anti-consensus buy and we had upgraded 2 quarters back. It did well. In between, then there was a little bit of a headwind that we got, and then again in the last quarter we did see a very sharp 30+% move. So it is playing out well, and our call is going decently well. As far as our thesis is concerned, we don't think it was a one-off of volume growth that we have seen. We believe that the high single, early double-digit volume growth will likely continue this quarter and for the coming quarters as well. More importantly, we believe that there is a favorable base that Asian Paints has, because last year, while you had above normal monsoons, which was impacting some amount of painting days, this year you have El Nino, so there will be more number of painting days that the companies can have. Also, last year there was some disruption because of elections, workers going. There is no likely disruption this time around. Secondly, there is a very sharp return of pricing growth, closer to 13-14% that they have taken. This quarter, we believe that effective price increases will be closer to 7%. Because of the timing of the price increases. But you will see 13-14% pricing growth coming in the next quarter. So also, if you see on the margins, Jan and Feb were pretty soft on the commodity cost, and usually companies will have 2 to 3 months of inventory. So in 1Q, we are not expecting a lot of pressure on margins. In fact, only a little bit of pressure. While most of the cost inflation will be seen in 2Q, companies have already taken sharp price increases to mitigate that cost inflation. So margin impact in 2Q also can be, much soft basically. So strong growth continuing with less margin impact, with competitive intensity going down. Chance for some re-rating lined up, and hence we believe that Asian Paints can do well and remains one of our top picks.
How have you penciled in Q1 from a point of view of demand coming in from rural markets? Second, there has been a reverse migration of labor back there in Q1 because of many issues from the cities to the rural area because of gas and other issues, and the wage increase which we are seeing in rural market, which is much higher than the urban market.
This is for paint specifically or overall sector?
Overall sector from a point of view, from a consumption point of view.
Right. No, like I said, I mean, we were expecting a bit of a weakness in rural this time around because of these issues that you highlighted. While there, there is a supporting factor on better wage growth, etc. We believe that will be played out in the coming quarters, and hence the impact of El Nino can get some cushion. So weakness in rural will continue a little bit. But it will not. It will be still growing higher than urban growth.
What about beverage stocks, Mir? And of course, one of those being Varun Beverages. The kind of commentary that came out through the Q4 earnings call was extremely strong. And what about some of the consumption plays linked to harsh summer, ice creams and the like, where milk prices have gone up, and therefore that could be margin dilutive, but volumes could be extremely strong, right? Are those areas at all something that you're liking? And if so, is there a preference tilt in terms of names?
As far as categories are concerned, each companies have very many categories. So there are pluses and minuses within the company. So while one may want to choose higher summer-centric categories can do better than the other ones. We believe it's better to look bottom up instead of looking category. You're right. I mean, soft drinks, carbonated beverages, ice creams, cooling hair oils. All these ideally should do better, but at the same time, you will also see certain headwinds in tea, certain QSRs. Those will be certain headwinds also. So you will have plus and minus mitigating factors that will play out actually.
Quite interesting. Mihir, thank you so much for taking the time out and speaking with us today. Good to get in your insights.
Thank you. Pleasure.
Okay, on that note, let's take a very quick break. By the way, the Nifty has breached 23,900. While it may be just a very mild move, but yes, the critical level has been broken in trade this morning. We'll continue tracking markets and a lot more on the other side of this break. Back with the market right here on ET now under pressure. We've reached the 23,900 print right now, led lower by select IT as well as auto names. They are the ones which are the biggest drag. Kotak Bank is now down almost 1.5% as well in trade. Some of the select metal plays like Tata Steel, Hindalco, heavyweights like Reliance, ITC as well are adding to the pressure, but specifically as a sector, it's definitely IT, which is the weakest link right now in trade. Having said that, there are a lot of spots of green as well. Looking at Exide, looking at Noro Pharma, Gland Pharma has struck a lifetime high for itself. If we can just bring up that intraday graph for you. There you go, 84 points higher right now. 2,500 or rather 2,460 is what that stock is currently touching. Samman Capital and Bharat Dynamics, which is now scaling higher by 3%. So a lot of individual names which also continue to hold out. The one other stock which is in focus is Puravankara. And very interesting play given that they are now expanding their Bangalore pipeline. So we thought we'll chat with Mr. Mallana Sasalu, the CEO South at Puravankara, joining in on the show right now. Mr. Sasalu, great to have you today on ET Now. Thank you for your time. Tell us about this recent acquisition of this land parcel in Sarjapur in Bangalore. The potential GDV of about almost 1,000 crore rupees, as we understand. Help us with the details. When is the expected launch timeline? What do you intend to build?
Thank you, Aisha. Thanks for having me on the show. Yeah, we've had some good times. So this is in East Bangalore on Sarjapur Road. It's around 6.4 acres and 900,000 square feet of developable area with around 1,000 crore rupees of top line expected. This is in line with what we are doing in this quarter. So far, we have done around 4.2 million square feet of total developable area, around 42 acres of land that will give that kind of yield, and 5,200 crore rupees of total developable value GDV that we have done in this quarter. That includes one in northeastern Bangalore on OMR, off OMR, 14.57 acres, which was outright, and some revenue sharing. It's around 1.82 million square feet of total developable area. And also one more we did in North Bangalore, and it's called Dodagubi, where it's around 11.23 acres of land that we entered into a joint development and a developable value of around 1,100 crore rupees. And also there was another Bangalore North acquisition that we did. This was an outright purchase of 9.73 acres with a developable area of around 0.82 million square feet and a value of around 800 crore rupees. So it's all in all, it's fantastic, and we've done well. This is continuation of what we did from FY25. In FY25, we had made acquisitions worth 13,000 crore rupees of top line, and in FY26 that we did 15,200 crores. This is as we are selling, selling and bringing the units to the market, we need to replenish that. So in that line that we are doing that.
It's quite intriguing that traditionally known for the IT sector boom, a city like Bangalore, and the fact that that sector is in a slowdown, you're actually expanding your presence even further in the city. And apart from this project that we just talked about, you've acquired some more land parcel, I believe, in Bangalore. Tell me, what kind of growth are you anticipating in the city's real estate market?
One of the things is one is the growth, and we expect Bangalore city to be growing at 15%. More than that, the consolidation has happened and continue to happen because of the listed players, the trust that we have built over the last 50 years, and that'll pay us well. So we're expanding our market share in Bangalore market. So that's the efforts that we are putting together. As far as Bangalore is concerned, and as you may see that the office absorption continues to be strong, and it's not, IT has not gone anywhere. In my opinion, that with the AI coming in and the AI deployment, that will bring a lot of jobs to Bangalore. And as you may see that the AI, the people who are in the center of AI, like Google and NVIDIA, have taken large spaces in Bangalore. So we continue to grow. And Bangalore is not currently, I think we have moved beyond IT. And if you go to Bangalore North and Hardware Park and Aerospace Park, a lot of industrialization that has happened in Bangalore North area, where we are very confident that more jobs are going to get generated, and more manufacturing will come to Bangalore. So we are very bullish, and I think we have right reasons to be so.
Hi, Sajid here. Give us a sense of the kind of demand that you're getting from GCCs for your in Bangalore as a whole as a market, and are you also seeing good demand coming from for larger parcels of area from GCC and other companies?
Yeah. So as you have noticed, Sajid, that last year in Bangalore, around whatever the area that was consumed, and GCCs took away 40 to 50% of that entire office area. So now the people are coming in and settling into this GCC, and maybe that is the reason why that these are a little bit more high-paying jobs compared to technology, which we expect that a little bit of larger areas and better specification and listed players. And in that order, maybe the preferences will go forward as far as GCC employees are concerned.
What has been the kind of pre-sales that we have been able to do in the first quarter so far?
So far, we have done well. So it's still that the numbers are being churned out, and so I think we have done well. So I just couldn't give you a number because of obvious reasons. That let's close the quarter, and then definitely we're going to announce what we have done so far in this quarter.
And for FY27, you had put in guidance there. Are you on track to meet that kind of guidance?
Yes, we are into 2.5 months or 3 months into the year, and so far that everything looks all right, and 11,200 crore rupees is the guideline that we gave, and we continue to hold on to that number, considering the number of of launches that we are expecting. We have launches, around 25 launches are there, out of which 7 are phase launches and 18 are fresh launches that are planned for the year. I only hope that we are able to get our approvals on time, and so if that happens, not if that happens, I expect that will happen with those kind of initiatives that what we have. We should be able to reach that number.
The big concerns which is there is a rising interest cost. Are you looking to tap the market for equity?
But not right away. The equity, we are not looking at equities right away. And I think we are comfortable with the position that what we are in. The cash position is very good. The collections are very good. And we continue to grow with our internal resources and also the payable when able debt kind of.
How are you looking at the commercial portfolio of yours and your entry into Bombay market?
Yeah, so now we have 5 redevelopment projects that are going on in Bombay, 2.67 million square feet of work is going on in Bombay, and also there are projects in Pune. What was the first question? Sorry.
From
the first question.
No, I just wanted to ask you about the commercial portfolio as well.
Commercial portfolio. Sorry, I missed that. Commercial portfolio is at 1.2 million square feet is now ready with occupancy certificate, and we are doing our best efforts to lease that out. And there are quite a number of RFPs running in the market, so we have participated in that. We're confident that we will be leasing that out soon. And we also have 800,000 square feet on Kanakpura Road, which is substantially leased out, 45 to 50% leased out or partially sold. So that's doing well, and IKEA has taken the ground floor, the first floor of 100,000 square feet plus in that building. And also we have a property in Nepal, which I think in the next maybe 6 or 8 months that we should be going for approvals and launching that project as well in the commercial portfolio.
Okay, good to hear that. Exciting times ahead. Malana, great to have you today on ET Now. Thank you so much for your time.
Thank you, Aisha. Thanks for having me here.
Okay, on that note, let's wind it up. In fact, right here on this edition of The Market in First Trades, it's a goodbye from Sajeev and me.
Hello and good morning. You're watching Midcap Masala on ET Now. I am Snehi Shah. With me on the show is my colleague Atesha Advari, as always. And this is a show where we're going to be diving deep into the broader end of the market, give you a sense of what's happening. At an index level, the Nifty is slightly under pressure, but you have a speck of green coming in across the mid-cap and the small-cap indices. Before we tell you everything at the index level, let's also take a look at some of the stock-specific buzzers from the broader end. And let's start by talking about KEC International. Good move, about 2.25% higher on that stock. The company has secured new orders worth 1,754 crore rupees across their transmission and distribution and cables and conductors businesses, including the company's largest ever tower supply order from the US. The wins take the company's FY27 order intake to over 4,000 crore rupees. Meanwhile, Sterling and Wilson Renewable is in focus after the company secured a $560 million EPC order for a 1 gigawatt solar project with 600 megawatt battery energy storage system in Egypt. This is the company's 3rd gigawatt scale order in the last 9 months. Strengthening its international order book, the stock is holding up with gains of 1.5% on the back of this. Next up, let's talk about Standard Engineering India and 10% upper circuit on that stock after the company outlined a strong growth outlook. The management expects 40 to 50% growth in its core business and is targeting around 250 crore rupees in revenue from its new AI data center vertical, despite expecting only about 4 months of contribution in FY27. SJVN meanwhile is in focus after the company signed a long-term power purchase agreement with Gujarat Urja Vikas Nigam Limited for about 658 megawatt of hydropower from 3 upcoming projects in Himachal Pradesh. This has helped the company secure long-term offtake for the capacity. The stock is holding up with gains of more than 2% on the back of that. And on to some brokerage action. Kotak Securities has maintained a buy on Alevis Life Sciences with a hiked target price of 1,315 rupees per share, basis which the stock is higher by about 2.5%. The brokerage expects earnings growth to be driven by steady API demand, a 2x growth in the CDMO business by FY29, and improved operating efficiency. And shifting focus to Shilpa Medicare, then DAM Capital has initiated coverage on Shilpa Medicare with a buy rating and a target price of 748. The brokerage house expects strong revenue growth driven by formulations, CDMO and biologics businesses, with human adherence seen as a key future growth driver for the company. The stock is up more than 5% on the back of this brokerage report. Okay, on that note, let's get started with the corporate conversations that we have lined up on the show. The first one with the management of Atul Auto. We've got Mr. Jitendra Adhya, the president of Atul Auto, joining us on the show. Mr. Adhya, hi, morning, and thank you so much for your time. You know, we've heard yesterday about the Delhi EV policy, big positive coming in for your company. Now, to talk a little bit about this policy, the Delhi EV policy mandates only electric three-wheeler registrations from Jan 2027. Help us understand how significant is this an opportunity for the company, and how are you preparing to capture this demand?
Thank you for having me on this show. Yes, it's quite positive for the industry, three-wheeler industry, and in particular Atul Auto as well, as we are into all fuel and particularly with hype in EV. We expect that definitely it is going to help us in a great way. We are there with our all multi-fuel variants across the entire country. And for electric, particularly, we have our own fixed battery model. We got swappable and fast charging also in place. So putting all together, definitely it's going to be a good opportunity for Atul Auto.
Okay, good opportunity for growth. That's the word coming in, Mr. Adhya. Good morning, Ashesha this side. Can you quantify the benefit for you? And do you expect your diesel and CNG portfolio to see a big dent as a result of these EV policy? And the fact that perhaps EV sales could go up, but other sales could actually decline as a result of this revised policy from Delhi government?
Very good morning to you as well. Look, we definitely, have all fuels available in our product portfolio, but in particular Delhi and NCR, we are not there with the diesel or not in a great way with CNG. So actually, it is not going to dent overall numbers for Atul. That is point number one. If you look at my entire sales composition, almost 1/3 comes from electric. So once such kind of policy boosters are in place, I'm sure that it will be beneficial in a short to long term for organization.
Okay, so that sounds good. Mr. Adhya, do you also believe that Delhi's policy could become a blueprint for other states? And if that happens, how well positioned is Atul Auto to capitalize on a broader shift towards electric three-wheelers?
Yes, it can be definitely, kind of a thing where other states can follow this policy in a time to come. I believe we need to keep little more patience once, it is stabilized, particularly for Delhi. The other states will definitely going to follow it. And as long as Atul Auto is concerned, we are all set with our infra. We are all set with our capacity. We have our all, entire supply chain lined up. So all in all, we are there to definitely contribute for this booster, and we are going to be benefited.
Adhya, how much revenue do you generate from Delhi NCR region in particular? And as a percentage of total sales, how much do you generate from electric vehicles?
As overall, we have approximately 28 to 30% comes from electric sales. In particular, Delhi, we don't have, as of now, we don't have presence, but we are there in NCR. And we very soon we expect that we will have our footprints in Delhi and other regions as well.
And with purchase subsidies and perhaps a clear roadmap that the Delhi government has now put into place, are you already seeing higher inquiries and stronger order visibility as compared to what it was earlier?
It's already there, and obviously with this policy I expect to be go up a bit higher. So definitely it is going to be, demand booster.
Okay, I understand that. Also, Mr. Adya, your partnership with Exponent Energy that envisages a supply of about 15,000 electric three-wheelers. What is your timeline on that execution, and how is that going to help you capitalize the opportunity that you're seeing in Delhi now?
This is for first 3 years, but I believe
Sure.
we are going to definitely going to grab the volume well before the deadline. And since these kind of enablers are there in the market, we expect that it will be very minute numbers, 15,000 or so, because 15 minutes charging it is as good as you are fueling your vehicle at conventional dispensing center. So this numbers is initially just to start, but I expect much better volume from this particular tie-up. Apart from that, we have our own single battery, dual battery, fixed battery solutions available, and we do have a tie-up for swappable battery with Honda. So this all possible options where consumer can definitely buy at their ease and as per their budget. We believe that Atul Auto will be greatly benefited.
And consequently, what will your FY27 revenue growth guidance be? You reported about 824 crores of revenue in FY26. And of course, the growth rate was also very strong in FY26 on a year-on-year basis. Will that continue this year as well?
I believe we will be definitely able to deliver much better than what we delivered last year. But really difficult. It's just a beginning of, the year. We are about to end the first quarter. So let us wait for another couple of days to see the first quarter result. And I am quite confident that we will be able to deliver much better numbers and volume for FY27.
14% was the revenue growth in FY26. So we can assume that it has to be at least better than 14% in FY27. Am I getting you right?
Let's hope so.
And what about margins in that case? Are you expecting any kind of margin expansion this year?
We will be benefited from, compensation of fixed costs, obviously. But there is a small challenge. There was a volatility in terms of, raw material price. But thanks, it was quarter one, so we have 3 quarters pending to recover and deliver much better numbers.
So, Mr. Adya, on the margins front, would you at least be at 10%, which was your margin number for FY26, if perhaps not higher, or if it's higher, any number you could share with us?
I believe we will grow than what we delivered last year. It is really difficult to give you the exact numbers, but will be better than what we did last year.
Okay, so that's the view coming in. So margins are expected to be better than last year, and growth for FY27 is also likely to be better than 14% that the company reported in FY26. And Delhi government's EV policy is also likely to be a major booster for demand in the Delhi NCR region. Mr. Adya, thank you so much for taking your time out and joining us here on ET Now. On that note, we need to slip into a very short break, but we'll touch base with the management on the other side. Don't go anywhere. Welcome back. You're still tuned into Midcap Masala right here on ET Now, and let's put the spotlight on PolyMedicure then. The stock has been in focus for the last several trading sessions. We now have the management of the company, Managing Director of PolyMedicure, Himanshu Bed, who is now joining us. Mr. Bed, good morning. Thank you so much for taking your time out to Shesha this side. First up, let's talk on the new government amendment for faster medical device licenses. The government has now approved that they will perhaps give licenses faster, streamlining the process. How will it benefit the industry as a whole and for PolyMedicure in particular?
See, I think today, a lot of, ease of doing, initiatives are taken by the government, and this is also part of that. And currently, the license were taking between 90 days to 180 days, and government needs to shorten that time. And I think there was an industry demand from very long time. And this is going to, help commercialize product faster. Even for PolyMed, time to market will reduce to bring new devices to market. And I think also there are a lot of areas where improvements are happening, or especially on patient safety side in the new reforms the government is bringing in. So all in all, I think it's a good note for the industry.
Okay, sounding positive over there. Hi, Mr. Ved. This is Snehi also joining in. Good morning. Give us your sense on what this does to your own launch pipeline now that the approval will start coming in faster. Does that accelerate your launch pipeline? Are we looking at launching more than 35 new products this financial year?
See, currently we have a lot of products under development. We are almost developing over 100 products right now, which is over next 3 years. So I think for this year, we have already called out around between 30-35 products. Hopefully, we'll be able to squeeze in a couple of more products or a little bit more than that. But let's see how it goes, because development pipeline needs its own time. We need to also do some clinical trials before we put the products in the market. So we are working on it, but I think it's good news for long run.
Okay, bullish in the long run, but can you quantify the benefit if you can put some numbers into perspective for us?
See, I think maybe we'll, as I said, we'll squeeze in maybe an additional 3-4 new products because the timeline will shorten up for going to the market. So I think that's what I can say right now. It's too early to call out.
Okay, understood. And going ahead also, we've spoken about limited domestic competition in the renal care space despite an open market. Do you believe that this faster approval now lowers the barriers to entry and perhaps increases your competition?
Well, I don't think so. I think it'll happen in every business, I think in medtech space. So I think that's not the point here. I think the important point here is I think government was able to, hear our request regarding anti-dumping investigation for the renal business. I think they've opened it already against China and Malaysia, recently announced. And I think there was a long, standing demand from the industry that there was a dumping happening, from the, companies out of Malaysia and China. And most of these companies in Malaysia have Chinese origin. So I think that was actually hurting the industry. And hopefully if this investigation goes successfully, I think then we'll see, at least, some breathing space for the domestic industry.
Okay, let's also talk about your guidance. And I understand you can't talk about the first quarter in particular, but at the end of last quarter, you did tell your investors that you're aiming for about 23 to 28% growth on the top line. Consolidated revenue guidance stood at about 2,300 to 2,400 crore. For the full year, does that remain intact, or would you like to revise your guidance based on the developments that have happened in the first quarter of FY27 so far?
No, I think the guidance was pretty wide, 2,300 to 2,400 crores. So I think we stick to the guidance. And so this is a significant growth over last year, where we didn't grow as much as we had planned. So, this year, our domestic business should grow over north of 20% plus, and export business should also hit, 15 to 16% plus growth rate, or maybe even higher, depending how the things pan out globally. So I think we are very bullish on what's happening in India as well as outside India. So we'll stick to the current guideline, guidance we have given for 2,300 to 2,400 crores.
Okay, understood. So sticking to the initial guidance for this financial year, also help us understand, we've earlier spoken about how the US has always historically seen faster approvals versus India, and that has made them a very highly competitive market when it comes to exports. Now that Indian companies have also got this approval from the government, faster licensing is what I mean. Do you believe this is going to improve the competitiveness that India has when it comes to global exports in your categories?
See, again, exports depend on the importing country, their regulatory landscape. So fortunately, I think Europe is in a very tight spot, and because of the transition from MDD to MDR, and it's taking much longer to enter in the European markets as compared to, let's say last 4-5 years. So I think that is kind of challenging. But US FDA, there has been some changes there because the US FDA were not accepting the test lab results, biocompatibility studies from India. And that led to some delay in filing for new products. And now most of the companies have to go to ASCA-approved labs in the US to get the product tested. And that has taken some extra time to launch the products in the US market. But I think things are getting more clearer now. And hopefully next 3-4 years will be very solid for the Indian medtech industry.
Okay, and what about margin pressure as a result of surge in crude oil prices and the fact that crude oil derivative prices also rose? I believe that is likely to hurt your margins in first and second quarter. Am I getting it right?
We have guided already that we should be between 25 to 27% EBITDA margin for the whole year. And I think even in the first quarter, we should be in that range only. And on the console basis, yes, it should be a little lower because of our international subsidiaries working at lower EBITDA margin, so which is between 23 and 25%. But overall, I think we were able to pass on certain costs to customers in quarter one. And quarter two also, I think that will happen. And fortunately, crude prices have started coming down. So hopefully that pressure will come off the table.
Okay, so that's your outlook when it's related to crude related costs. But also, can you give us an outlook on how are you looking at inorganic growth if you're considering acquisitions, anything in the offing?
See, we have done 2 last year, and I think we're trying to absorb them, and I think it's going to take a while to set them up and get them to higher operating margins. We are on a lookout, but of course, anything which is around technology space, especially in cardiology, renal, or critical care, will figure out. But nothing on the cards right now. If there's anything else, I'll definitely let you know.
How has demand from Europe and US been? Has there been any impact of geopolitical crisis either on logistics or otherwise on demand per se?
See, I think the biggest challenge is logistic right now because many ships have not been calling on Indian ports, and the containers are missing the delivery schedules. I think that's a larger concern, and I think there I need government intervention that if the shipping can be improved out of India, because that is the current challenge our customers face globally. And the freight rates have gone up also, recent past. But hopefully with the crisis in Middle East, kind of getting resolved or on the verge of getting resolved, I think things will start to cool down. But currently, yes, situation is very tough for exports.
Okay. And Mr. Beth, what about higher value therapies? They're steadily gaining share. Can you give us a sense of what your mix is going to look like going ahead?
See, I think we'll stick to our core business of infusion and vascular access, which is still going to contribute over around 50-55% of revenue. But I think cardiology, critical care will start gaining more traction as we have a higher gross margin on those kind of product ranges. So we are working on those businesses. Just started 12 to 16 months ago, these new businesses. But hopefully next 3-4 years, they'll become significant and start contributing to more margin.
What will that target margin profile be over the period of next 3 to 4 years, if you can give a number?
See, currently we are operating around, say, 66 to 68% gross margin, and typically would like to move to around 68 to 70% gross margin in next 2 to 3 years.
Okay, so that's the outlook going ahead. Mr. Beth, so good to be speaking with you. Thank you so much for your time today.
Thank you.
We are just highlighting some stocks that are buzzing from the broader end. One of them is Shilpa Medicare. Two positive updates coming in over here. Their wholly owned subsidiary, Shilpa Biologics, has entered into a co-development and supply agreement with Orion Corporation. And this is being done for a particular drug. This is a pharmaceutical company headquartered in Finland. And they're going to be co-developing the nivolumab biosimilar, which is used for cancer immunotherapy. So big positive over there. And earlier this morning, we've also had a note coming in from DAM Capital, wherein they have initiated a buy rating on Shilpa Medicare with a target price of 748 rupees per share. They believe that the company has finally entered the monetization phase, and years of R&D will now begin to bear fruit. And they're expecting revenue, EBITDA and PAT to grow at 22%, 29% and 32% respectively CAGR over FY26 to FY29. They also believe that the next generation of promoters will assume leadership roles and drive the next phase of growth for the company. They're saying that the B2B model is consistently generating sizable licensing and milestone income for the company, with recurring manufacturing revenues as well as profits. So very good note coming in from DAM Capital on Shilpa Medicare, initiated buy rating, target price of 748 rupees per share, which by the way is an upside potential of roughly 30% from where the stock is currently trading. So two big positives coming in from Shilpa Medicare, for one from DAM Capital and one of course their tie-up for their oncology drugs. So looking positive over there. But shifting focus, the other stock in focus is Yes Bank. The board has approved enabling resolutions to raise up to 16,000 crore rupees through equity and debt. The proposed equity issue will be capped at 10% dilution and requires shareholders' approval at the bank's AGM on August 19. Mitali is joining us with the details of this fundraise.
Right, talking about Yes Bank. So the bank is again in focus as it plans to strengthen its capital base once again. Now, the bank's board has approved enabling resolutions to raise up to 16,000 crore rupees through a mix of equity as well as debt securities subject to shareholder and regulatory approvals. Now, the proposed fundraising includes rupees 7,500 crores via equity issuance and 8,500 crores via debt securities, which may be raised in domestic as well as the overseas markets. Importantly, the bank has clarified that the proposed equity raise will not result in any aggregate dilution of more than 10% of its existing share capital. Even if the debt instruments are convertible into equity, the overall dilution will remain capped at 10%. The approvals granted by board are enabling in nature. The proposal will now be placed at the company's AGM, which is scheduled to be held at 19th August 2026. Also, this marks a repeat of the fundraising plans which were approved by the Yes Bank board in June of 2025, where a similar 16,000 crores of fundraise program was there, comprising 7,500 crores from the equity and 8,500 crores from the debt. So from a capital perspective, if you see Yes Bank, it remains comfortably above the regulatory requirements. As the end of March 2026, the bank's capital adequacy ratio stood at 15.3% compared with 15.6% a year earlier, well above the regulatory minimum of 9%.
Okay, Mitali, thanks so much for joining us with all those details. Yes Bank in focus on the back of that. But that's all the time we have on this edition of the show. Thanks so much for tuning in. Bye now, sell now. We'll come up next.